Hey everyone, most of the employees have their retirement plan set up with the employers, and in US it's called 401k plan. Now, have you ever wondered what these 401k plans invest their money into? That's the biggest risk I'm talking about. If you open your brokerage account, you can see that most of these funds passively invest into the S&P 500 index and related products. It could be ETF, it could be mutual funds, everything in and around S&P 500 index. Now, what is S&P 500 index? As the name says, it's a top 500 Standard & Poor, top 500 publicly traded US companies. They are market capitalization weighted. What does that mean? Market capitalization is nothing but how much the market is assigning a certain price to each companies. For example, Apple trading a $2 trillion market capitalization, it means that market is pricing Apple at $2 trillion market valuation. Now, the minimum valuation for a company to enter into S&P 500 is $14 billion. There are stringent conditions to get into S&P 500. That's precisely why S&P 500 has bet 85% of fund managers consistently. And S&P 500 has returned 9 to 10% returns consistently over last 4 to 5 decades. Now, with such stringent criteria, and the S&P 500 only accepts winners, continuously it only accepts winners based on the selection criteria, which means winners, the companies that make it big, companies that become bigger and bigger, becomes profitable and qualifies to enter into S&P 500. So they are the cream of the companies out there. So how can, when your 401k is having significant weightage to S&P 500 index, how could it underperform the next 10 years? Answer lies in this chart. You could see that the S&P 500 index comprises, the distribution is the information technology, that is the tech stocks, occupies 30% of the distribution. Consumer discretionary 13%, financial 11%. These three put together occupies 50%. Well, I don't have to tell you about what is happening with financial industry today. Banks after banks are collapsing. The credit is going to be crunched. The inflation is remaining high for a foreseeable future. With that, the interest rate is going to become range bound. The new normal is going to be 4 to 5%. If that is the case, high growth tech companies are going to underperform in the next 10 years because they are long weighted growth companies. Typically, growth companies are, usually not so profitable. Even if they are profitable, they are not going to be valued at the similar valuation what it was valued in the last decade. Precisely why, if you look at this chart, S&P 500 has returned in the 10-year period from 2011 to 2021. The last 10 years, S&P has returned 14.8%, which means close to 15% returns, which is at least 5 to 6% above its historical returns, right? Now, that was the last decade. The reason was precisely the heavy weightage of tech stocks, the FANG, that is Facebook, Alphabet, Apple, Netflix, Google, plus Microsoft and Tesla. You add it, they occupy 32% of the whole index. And S&P 500 valuation is 14 times X FANG, Microsoft and Tesla, forward earnings. And S&P 500 index itself, including FANG and Microsoft, Tesla, it's, trading at 18 to 19 times earnings. That is a difference in valuation. So it is looking pricey when you add these tech heavy index, right? These top 8 companies. Now these top 8 companies are bound to price correct. They might not, bound to time correct. Which means that they might remain range bound in this price for a significant long periods of time. It could be like for even 8 to 10 year period, these top 8 to 10 companies are going to remain at the same place, except maybe Tesla. Because the valuations, they are richly valued and they occupy significant percentage, and with the new normal of interest rates, tech stocks are going to underperform. Now, most of the tech stock I'm talking about are in the top 8 to 10 criteria, but there could be big performers below that line, right? So what is the issue with S&P 500 index itself? The issue is in year 2000, if you see, there were companies, S&P 500 composition had GE, an Exxon, Citigroup, Pfizer, AIG, Intel, Cisco, all these companies. Now look at the composition just 10 years later. You have Exxon, GE going down the order, Exxon taking over, Apple entering into the list straight to the second position, then Microsoft, then IBM, Chevron, Walmart, Berkshire Hathaway entered into top 10. Now you take another 10 years ahead. Look at the composition now. You don't have many of those companies. You don't have an Exxon, you don't have a Chevron, you don't have a Intel or AIG or any of these companies. Instead, it's all replaced by, you didn't even have a Facebook in 2010. You don't have a Tesla. Many of these companies were small capitalization companies in 2010. So the composition itself is changing, and if you say another 10 years, you say come 2032, the composition could have, many of these companies could drop off. We don't know what, and many new companies could come and replace the top 10. This is what I'm talking about. Now, the newcomers that will enter into the top 10 could be completely unexpected players out there. It could be a completely different industry altogether. It could be electric vehicles, whatever that is. We don't want to play that guess game, but the point is S&P 500 is going to have a mean reversion period in the next 10 years. What do I mean by that? Look, in the last 10 years when I mean 2011 to 2021, it has returned 15%. But what is historical returns? 9 to 10%. Common sense prevails. So it says that the next 10 years, S&P 500 will return only subpar, that is 4 to 5% returns in the next 10 years, which means it will revert back to its average or mean the next 10-year period. It has to happen. Now, this is the biggest risk I'm talking about. So it is a good idea to go ahead and check your portfolio or a 401k plan and readjust your balancing in the 401k and move some percentage into maybe an MSCI emerging market funds. They are going to do well because when interest rates settle down at some stabilizes at some levels, the emerging markets are going to do well in the next 10 years. Industrials might do well, small cap companies could do well. So you could invest in Russell 2000, you could invest in an MSCI EM fund or MSCI World Basket. So it's a good idea to diversify. Not only it diversifies from a country risk standpoint, it also diversifies from a industry segment wise, and it helps you to achieve some more percentage upside in the next 10 years. But trust me, over the next 20-year period, S&P 500 still will return 9% because that is a historical mean average, somewhere around 9%, because that is a mean, right? So that's the point I wanted to bring today. So please go ahead and check your 401k and see how the distribution is and ensure that it is well diversified and not too concentrated with S&P 500 index. Just want to bring that up. Thanks for staying with me. Signing off, Sandeep, Anand.